Hey guys, today I'm going to be doing a tax rate recon, which is awesome, especially given that I only learned how to do one yesterday. Thank you, naushaad. But hopefully this is going to click within 10 minutes for you and possibly not 3 years like it did for me. So let's get into it. Cool. So I know maybe it's a bit weird. I'm doing a tax rate recon before I've even done a deferred tax episode, but honestly, I'm just so excited that I finally learned how to do one that I had to make a video. First things first, what is a tax rate recon? Well, it's required by IAS12 paragraph 81C, i.e. your deferred tax standard, and what it does is reconciles your theoretical or anticipated tax expense to your actual tax expense. And I say theoretical tax expense because what it's saying is if I take my pre-tax profit and I multiply it by 28%, i.e. our corporate tax rate or whatever the applicable corporate tax rate is, this will give me my anticipated or theoretical tax expense. But in reality, we know that this anticipated or theoretical tax expense almost never equals our actual tax expense because SARS and accounting don't always vibe together. Sometimes SARS disallows certain deductions, whereas accounting would have granted a full 100% deduction. Therefore, we have certain reconciling items. So in summary, it's accounting for the differences between our anticipated tax expense and our actual tax expense. And importantly, our actual tax expense, as we should know, is made up of our current tax, and that's what SARS says this year, that's how much you owe, right? And we know how to do that. That's using our taxable income multiplied by applicable tax, rebates, etc. That's your current tax. And the deferred tax accounts for the temporary differences between what accounting recognized and what SARS recognized. So if you think about a deferred tax journal entry, either it's going to go through profit or loss or OCI, and that really depends on where the transaction originated from. And because our starting point of a tax rate recon is our pre-tax accounting profit, we're dealing with only profit and loss items. Therefore, the deferred tax implications that go through profit and loss have mostly already been dealt with. Therefore, you don't need to stress yourself as much about deferred tax implications here. On the whole, the tax rate reconciliation is dealing with reconciling items that are not recognized in deferred tax. So when doing this tax rate recon, those reconciling items will generally be the differences between what was recognized in our current tax calculation versus what we did in our accounting profit calculation. So the next question is, how do we even do a tax rate recon? Well, IAS12 paragraph 81C, I and II recommend two methods. The first being that we have a numerical recon between our pre-tax accounting profit multiplied by 28%, i.e. our anticipated tax expense, and our actual tax expense. And the second method being a recon between the 28%, i.e. the corporate tax rate, and our effective tax rate, which is our tax expense divided by pre-tax accounting profit. So in the first method, this is reconciling two rand figures, whereas in the second one, we are reconciling two rates. So for example, if our pre-tax profit was 5,000 and our tax expense was 900, then we'd know that our effective tax percentage would be the 900 divided by 5,000, which is 18%. And the whole point of the tax rate recon would be reconciling the 28% corporate tax rate that we anticipate to the 18% that we actually incurred. But I'm not going to do that method because I don't want to. So we're going to go through method one, which is comparing two rand figures. Alrighty, so in method one, we know that we are reconciling our pre-tax profit multiplied by the corporate tax rate to our actual tax expense incurred. So if we say, for example, our pre-tax accounting profit is 100,000 rand and our actual tax expense for the year is 25,000 rand, we know that our starting point is to take that pre-tax accounting profit and multiply it by a corporate tax rate of 28%. Now looking at that, we've got a 28,000 anticipated tax expense, but our actual tax expense is 25,000 rand. So the point of this reconciliation is to account for the differences between our anticipated tax expense and our actual tax expense, so that 3,000 rand difference. If we're doing method number two, just note that our average effective rate would be the 25,000 actual tax expense divided by our accounting profit before tax, which gives us 25%. So you'd be reconciling the 28% to the 25%. So I guess the next question is to say, what caused the difference between the 28,000 rand and the 25,000 rand actual tax expense? And because we're all tax wizards, we actually know what some of those reconciling items might be. So reconciling items are things where your tax treatment was different to your accounting treatment that was not dealt with in the deferred tax through profit and loss. The first example I'm going to give is non-deductible expenses. And these would be reconciling items because if you think about it, SARS has told us, no, you get no deduction. So no subtraction from your taxable income. Whereas accounting profit has accounted for 100% deduction. Therefore, your theoretical tax expense is actually lower than your actual tax expense. Therefore, the reconciling adjustment would be to add back to your theoretical tax expense to get to your actual tax expense. So for example, if your expense that you weren't allowed a deduction on was 1,000 rand, then the reconciling reconciling adjustment would be to take the 1,000 Rand multiplied by the applicable tax rate of 28% and then add it back to your theoretical tax expense so that you get to your actual tax expense. And so reconciling begins. The next example of a reconciling item is something like exempt income. So for example, dividends. We know in tax when we get dividends, those dividends are 100% included into our gross income. But if they're local dividends or if they're foreign dividends, but we have a 10% shareholding, etc., we're going to get a full deduction. Therefore, the total effect of that dividend is nil in our taxable income calculation. But in accounting, that's just accounted for as 100% inclusion into dividend income, right? Therefore, the effect being that our accounting profit is higher than our tax profit. So the theoretical tax expense would be higher than our actual tax expense. So our reconciling adjustment would be to decrease our theoretical tax expense to get to our actual tax expense. So if we had a 5,000 Rand local dividend, our reconciling adjustment would be to take the 5,000 Rand times 28% and decrease our anticipated tax expense to get to our actual tax expense. A nice one to remember is our sale of capital assets, because in tax we know that we get an 80% inclusion into our taxable income, whereas in accounting we would recognize a full 100% inclusion, right, on the profit. Therefore, our accounting profit is greater than our tax profit, so it will need to be decreased by that difference. And now the last one that I'm going to go through properly, and I think it's definitely the most complex reconciling item, at least for me, is the assessed loss now recognized. So remember, an assessed loss is basically like a negative taxable income. Our deductions exceeded our gross income, so we're basically paying no tax. But the whole vibe in accounting with an assessed loss is that in some circumstances you can use it to offset our deferred tax liability. So we can cancel out the deferred tax liability by using some of our assessed loss. And there's certain offsetting requirements, but for simplicity's sake and because I just don't know, I'm not going to get into that. So I'm going to give you an example. Okay, so let's say in 2020, last year, we had an assessed loss of 100,000 Rand. So we're now paying tax, right? And we have a deferred tax liability of 15,000 Rand. Now accounting says that we can use some of the deferred tax relating to the assessed loss to offset the deferred tax liability. So what we do is we calculate the deferred tax on the assessed loss, which would be the 100,000 times 28%. So we get 28,000 Rand relating to the assessed loss. Now, because the deferred tax liability is 15,000, we can offset the entire deferred tax liability so that the resulting effect is that we have no deferred tax liability for the year. And what would be really nice to do here is like a whole T account and like journal entries and stuff, but for the sake of time, I'm not going to do that. But for the sake of this, we have now offset 15,000 Rands worth of the deferred tax on the assessed loss. We have no more deferred tax liability, but we have this remaining 13,000 Rand of deferred tax relating to the assessed loss that we haven't utilized. And the principle in this case is if we expect that we will be able to utilize that assessed loss in the following year, then we will be able to recognize a deferred tax asset of 13,000 Rand. If not, then we are not allowed to recognize that 13,000 Rand at all in this year. If it's the case that I don't think I'm going to make enough taxable income to offset my assessed loss or to utilize my assessed loss in the following year, then it's going to give rise to a contingent asset rather than a deferred tax asset. But what does this whole spiel have to do with reconciling items? Well, in 2020, if I did think it was possible that next year I'm going to have enough taxable income to use my assessed loss, then I don't have any reconciling items because I'm going to use my full assessed loss, the deferred tax relating to the assessed loss, and therefore my accounting profit and my tax profit all going to be fine, no reconciling items. However, if I made the assumption that next year, the 2021 year, I won't have enough taxable income to utilize my assessed loss, then I can't recognize a deferred tax asset, and I'll have a reconciling item in the year that I generate enough taxable income to utilize my assessed loss. So for example, if I happen to generate sufficient taxable income in 2021, that would be the year in which I would have a reconciling item for that remaining 13,000 Rand of the assessed loss. Now let's assume in 2021 I've actually generated taxable income. Therefore the principle is I can now utilize my assessed loss. So the steps here are to firstly reverse out the full deferred tax relating to that assessed loss, so the full 28,000 Rand. Now we can recognize that remaining 13,000 Rand that we didn't recognize, and this gives rise to a reconciling item. So the journal entry for this remaining 13,000 Rand would have been to debit our deferred tax asset and to credit our deferred tax through profit and loss, with the effect being that if you look at our tax expense, the deferred tax portion is now going to be a credit to 13,000 Rand, i.e. it's going to be a negative 13,000 Rand. right? It's like a negative expense. With the effect being that on our starting point of accounting profit pre-tax, we have nothing, whereas our tax expense shows a negative 13,000 Rand. So if you can see that we're reconciling 0 to negative 13,000, we have our reconciling adjustment is going to be to decrease that 13,000 Rand to get to our actual tax expense. So basically, because that 13,000 Rand should have reduced our tax in 2020, but is only being recognized in 2021, we have a reconciling item. With this reconciling item, decreasing our anticipated tax expense to get to our actual tax expense. And then other things that I'm not going to go through, and this is not a closed list, would be things like a change in rate. So if our tax rate changed from say 29% to 28%, this would affect our tax rate recon, as well as if we paid more tax last year than we should have, this also causes a reconciling item. But there are lots of items. I think the principle here is to just think, well, what did tax do? What did accounting do? And was it dealt with in deferred tax? And if not, then we're going to recognize it as a reconciling item in our tax rate recon. And that's that. And I hope it made more sense. And if not, that's fine. You have several years to learn how it works. And don't beat yourself up if it's just not clicking with you, because it did not click with me for very, very, very long. Anyway, guys, I hope you have a lovely day, and I'll see you next time.